Okay, for this Form 1040NR tutorial, I want to cover an example where a non-resident invests in U.S. rental real estate, and so they're generating U.S. rental real estate income from tenants, and so they need to report that income and expense on a tax return and potentially pay any taxes if they have net profit. So I've got the sample 1040NR here in front of us. We'll go through all the pages on this form, and then I also have one slide covering the fact pattern. So we'll go through the fact pattern first and some of the rules and the elections that we'll be making, and then we'll jump into the return itself. All right, so the Form 1040NR is generally filed by non-resident individuals. Now, the 1040NR can also be filed by non-resident estates or trusts, but in our scenario here, non-resident individuals would file this if they have income in connection with a U.S. trade or business, or if a non-resident has U.S. source income that's not effectively connected income with the U.S. trade or business. This is often referred to as FDAP income. So it's interest, dividends, rents, royalties, things like that. And if there weren't any withholding taxes, then they might need to file. So in our case, we're going to have a scenario where John Smith, he is going to be engaged in a U.S. trade or business and has ECI by virtue of having this U.S. rental property. So the fact pattern we've got here, we've got John Smith. He's a citizen and full-time resident of the BVI. And so John wants to invest into some U.S. real estate. So what John does is he opens a Florida LLC. He's the sole owner. And the LLC does not make an election to be taxed as a C Corp, right? And so that's important because what that means is that the LLC by default is a single member LLC and a disregarded entity. And so all of the activities of the business are going to be reported on John's personal tax return, so his 1040NR, and that's where he pays the tax. If, in contrast, he made a C Corp election, then the LLC would be filing an 1120, and the LLC would be paying the tax directly. So the LLC here purchases a single-family home in Florida for $568,600 in cash, right? So he did not finance it. He just contributed the cash and paid for it outright. The purchase price of that $568,000, John is allocating it $100,000 in fair market value to the land, $450,000 to the building itself, and then $18,600 is to fixtures. And so that's 5-year property. And the reason why these breakouts are important, obviously, is because land is not depreciable. The building, the structures themselves are depreciable over a straight line basis, 27 and a half years for residential property. And then 5-year fixtures property, obviously depreciable life is much shorter, 5 years, but we're also eligible for bonus depreciation. So for 2022, bonus depreciation can be up to 100%, right? And so we're going to have a 100% bonus depreciation on those amounts, and so that's going to help lower our taxable income. Now, the LLC hires a rental property management company to accept rents and manage the property. And so the property is purchased and it's rented immediately to a tenant starting on March 1st, 2022. And during the year, they collected $20,000 of rental income. Now, John provided a Form W-8 ECI to the management company, stating that he's going to be treating this as effectively connected income. He's going to be making this 871D election. And so what that means is that now the U.S. source rents are not subject to a gross basis withholding tax. Remember, rents are kind of by default treated as U.S. source FDAP income. And so if paid to a non-resident, they're subject to withholding tax, unless you make this 871D election, and then you can treat it as ECI. And so that's what we're going to be doing here on the 1040NR. And so John's going to be able to report the income, the expenses, and he's going to be subject to tax on a net basis and not a gross basis. All right, so let's have a look at the return itself, and we'll start going through some of these main pieces. So the first one to note, obviously the name of the individual and their mailing address, and then the filing status. So John is a single filer, so he's not married, and so he's checked single filer for 2022. And then the ID number, this is his ITIN, right? So in order to file a 1040NR, you need to have an ITIN, or you could have a social security number if you were formerly a resident, now you moved out of the U.S. but you will need some form of tax ID number in order to file. So that's either an SSN or an I-10. So page 1, you can see here that the income effectively connected with the U.S. trade or business, no numbers here, right? And the reason for that, as we'll see later, is that the rental property generated a net loss for the year, and it's a passive activity loss. So that's why we're not seeing anything flow through to page 1 here. But of course, we'll look at that in more detail later. So what you'll notice is no taxes are going to be due with this return for the year, right? So all of these are zero, no tax, no taxes owed, no refunds, nothing like that. And again, that's because after we look at the rental property, Schedule E, he's going to have a net loss for the year. And so for that reason, unless he has profits, there's not going to be any taxes owed. So first one form I want to start with is Schedule OI. So Schedule OI should be completed with the return. A lot of these are just yes or no questions. They kind of drive whether or not you need to complete other parts of the return. But in this case, nothing too complicated going on here given John's circumstances. So A and B, right, he is a citizen and resident of the BVI, so he's indicated as such there. And then these questions here about his prior U.S. residency status, right? So he's never been a green card holder. He's never been a U.S. citizen. Never really had any kind of visa other than just a tourist visa. So you can enter not physically present in the U.S., no U.S. immigration status. That's appropriate given John's circumstances. Now in section D here, you should be disclosing the number of days that you entered and left the U.S., and that's because you need to track your days of physical presence to see whether or not you trip over that line and perhaps meet that substantial presence test, right? So it's something you definitely want to avoid as a non-resident. So John has disclosed the days that he was here in the U.S., just seeing the property, signing final documents, things like that. And then in item H here, he's disclosed the number of days that he was in the U.S. in 2020 and 21, which is 0, and then 5 days in total over that range in the United States. Now, he hasn't filed any tax returns in the prior years, right? So he's indicated no there, not filing a return for a trust, and we're not claiming any kind of exemptions of income under a relevant U.S. tax treaty. Now this question M here, this is really important for John's circumstances here, right? So in question M1, it's asking us, is this the first year you are making an election to treat income from real property located in the U.S. as effectively connected with a U.S. trade or business under 871D? And the answer is yes, right? We are making this election. So we've checked this box for yes, because this is the first year. In subsequent years, we'll check this box instead. But we've checked box M1, and then we've attached the appropriate 871D election statements. All right. Now, moving on to Schedule E, where we actually report the income and expense of the rental property. So questions A and B at the top here, we did not make any payments requiring 1099 reporting, so we've checked no. We've entered the address of the rental property itself, right? The type of property is number 1, so single family residence right here, and the number of days that it was rented during the year, and the number of personal use days, which in our case is 0. Now, rents received, remember he collected $20,000 in rent from the tenant during the year, and then he's reported all of those relevant expenses in connection with the rental activity that were incurred during the period. And again, all of these are generally managed by the property management company, and so they help track all of this stuff for John. Now, the important point to note there is line 18 for depreciation, right? So you notice what is quite common with a lot of rental properties is you might be cash flow positive, but when you factor in things like non-cash expenses such as depreciation, that completely wipes out your profit, and so that's generally a good thing, right? You can help lower your taxable income, and so that's what John has done here. He's recorded $31,000 in depreciation expense. So if we jump to the depreciation schedule first, and then we'll come back to the other pieces, we want to talk about depreciation for the rental property. So the home itself, the building, again, that's depreciated over a 27.5-year period under the straight line method. Land is not depreciable. And then the fixtures we're reporting as 5-year property, which is eligible for bonus depreciation. So if we look down here, the 27.5-year straight line property, the building itself, the depreciation expense for the current period is $12,956, and then the $18,600 in bonus depreciation on the fixtures totals up to $31,000 and change of depreciation. So that's how we're getting the $31,000 in depreciation expense that's being reported on Schedule E. All right. Now, once all of this is done, again, we're treating this as a passive activity, right? So rental activities are per se passive, right? There are or active participation rules, right? If you're a U.S. resident and you actively are kind of involved in the property, you get that exclusion up to $25,000. But in our case, it's just a pure passive activity for John. He's got a rental property management company that's doing everything else. And so for that reason, the losses are being treated as passive activity losses. So we do have an 8582 here. We've indicated here that on 2B, we have activities with a net passive loss for the year, so $16,406. And so those amounts are going to be carried forward to subsequent years, right? So they're unallowed losses here in Part 7. So carry forward the losses can be used in the future to offset future passive gains, right? So that's why it's important to make sure we're doing our 8582. Now, the really important part here, again, is going back to this 871D election. So this election, we are claiming the 263A-3H safe harbor. So this safe harbor is claimed if you make repairs or maintenance expenses to property, and you can effectively just deduct to the costs rather than have to capitalize and depreciate them. Very common election that's made given the circumstances. Certainly, really look at your facts and circumstances to confirm whether or not this makes sense for you, right? Not always the case, but in our case, it was appropriate to make this election. And then the big important one here is the 871D election. So remember, if you're a non-resident and you're receiving rents from U.S. real property, that's going to be subject to tax on a gross basis unless you make this 871D election to be taxed as ECI on a net basis. And so we've included this election here, right? So taxpayer elects to treat the real property as income effectively connected with conduct of a trade or business in the U.S., right? And so under the regulation, we have to disclose information on the property itself, how we own it, if there are any substantial improvements to the property. There's a number of items that are listed out in this Treasury reg that asks us to disclose on the election statement. In our case, these are the relevant pieces, right? So this is the real property address. We are letting them know that we own this property via a 100% ownership interest in John Q. Smith Real Estate Holdings, LLC, right? So that's his Florida LLC that he set up. And then we've disclosed the EIN and the address of the LLC in Florida. Okay, so once we have the election in place there, we've done all the other schedules that are required. We can touch on the 4562 as well, right? So the 4562 is where we report the depreciation and amortization expense for the period. And so the special depreciation allowance, or this bonus depreciation, that's the piece that's coming from the fixtures, right? So the 18,600 is the bonus piece. And then the amount of depreciation on the building itself, the 27.5-year straight line amount, there's the 450,000 that's attributed to the building, month placed in service, 27.5-year recovery period. And so there's the $12,956 of depreciation expense on the building. Okay. All right. So I think that covers it for everything we wanted to address in this video. If you have any questions, please feel free to leave a comment below. Happy to answer any can. And I look forward to seeing you again on the next video. Thank you.